Welcome back to Alternative Investing with Mike. On this episode, we will see how we can use options to improve the returns of our Chinese ETF holdings using a simple yet effective option strategy. Recently, Ray Dalio of Bridgewater said the global markets are facing a special moment. He's referring to the relative attractiveness of Chinese assets. Global investors have been underinvested in China. The U.S. has reached the end of a long-term debt cycle with interest rate reaching 0%, and the wealth and income gaps are the largest in the U.S. since 1930. These and other reasons make China a relatively competitive place to move capital to. So now is as good of a time as ever to start allocating assets to the Chinese market. In an earlier episode, we went over the top 5 ETFs suitable for the Chinese stock market based on each ETF's unique characteristic like liquidity or volatility. However, regardless which ETF you finally choose to invest in, a buy and hold strategy must endure the ups and downs of a typical volatile Chinese equity market. Back in the 2015 Chinese bull market, everything went up in late 2014 and early 2015. It felt like the sky was the limit. The market reached a fever pitch on June 9, 2015, and the CSI 300 index reached 5,380. But in a month, the market fell over 30%. The market attempted a rebound in July, but fell another 30% in August from the high reached in July. Avoiding large losses in your investment over time does more than picking the right stocks. A study of the S&P 500 index has shown that if an investor can avoid the 6 worst losing years where the S&P 500 index fell more than 20%, the investor would have created 10 times more wealth. So what can we do to avoid large losses in our investments? One simple yet effective strategy is to use options to mitigate the negative impact of these extreme moves in the market. The idea to use options to hedge against extreme moves in the market or black swan events is not new. However, the inspiration for this particular loss mitigating option strategy came from the book The Dao of Capital, Austrian Investing in a Distorted World by Mark Spitznagel. I highly recommend this book to anyone who is interested in hedging tail risks of long equity holdings. He made many insightful observations of managing unexpected market risks. So please read the book thoroughly if you want the whole story behind the methodology. Here, I will just show you this strategy using a real-world example. I'll put the link in the show notes if anyone is interested in this book. The strategy presented in the book is to spend 0.5% of your total capital in deep out-of-the-money put options every month. Deep out-of-the-money puts can be options with strikes that are 30% lower than the current spot price, or around 0.5% delta. Put options that would expire in 2 months, and you do this every month to have a consistent portfolio of put options. The rest of the capital will be fully invested in a long ETF holding. For our example, we will allocate $50,000 to ASHR, which tracks the Chinese CSI 300 index, the main index used by global investors to gauge the Chinese stock market. As you can see in this example, the Jan 15, 2021 options are the best choice for our 2-month option expiration requirement, since it has 59 days to expiry at the time of this recording. Due to illiquidity, While the 0.5% delta puts are offered at 20 cents, the 26.71 strike puts, which have a delta of 1.9%, are only offered at 9 cents. Of course, in buying puts, we always want to choose higher strike puts. The strategy calls for 0.5% of the total capital in puts, but in reality, we may have to spend a little more depending on the level of implied volatility. In this case, I found that 0.6% of total capital every month spent on put options offer more protection while only slightly increasing the cost. Given that we have $50,000 to invest in the ETF ASHR and put options, 0.6% of $50,000 is $300. $300 will buy 33 of the Jan 26.71 strike put options. Remember, put options have a multiplier of 100, so each put contract, in this case, is actually $9. Since we are buying 2-month puts every month, once the strategy is up and running at any given time, we would have put options that would expire in 1 month and 2 months. However, in this example, we're just starting out, so we will have to buy 1-month put options too. December 31 strike puts is the best choice at 10 cents. Using 0.6% of the total capital, we will buy 30 of these puts. Now let's see what would happen if the market dropped 20%, 25%, or 30% like it did back in 2015. Using Black-Scholes equation, we can calculate the price of put options after each drop. Let's take a look at the calculation for the 20% drop. Our $50,000 investment in ASHR would have lost $10,000, but our December 31 strike puts will be valued at $1.86 US, and that's a jump of 18.6 times from 10 cents. So the P&L from the December put options would be $5,288. Similarly, our Jan puts jumped from 9 cents to 94.6 cents. That's a 10-bagger. The profit is $2,826. Totaling our profit and losses together, the total loss that we experienced in this portfolio is only $1,856 or 3.7%. We effectively mitigated 16.3% of the loss. As you can see from the results of 25% and 30% drops in the market, our losses are largely mitigated. In fact, at 30%, we are actually turning a profit. I hope this simple example demonstrated the power of put options to mitigate losses in sharp and large market corrections. However, in practice, there are many other issues to consider. For example, how do you roll the options every month after expiration or close to expiration? What strike puts do you choose to buy? Also, what if the volatility increases hugely and you cannot buy options cheaply? There are many real-world issues to consider when implementing this strategy. This example gives us a good idea and an excellent starting point to explore this kind of loss mitigating strategies with options. I hope you all find the information in this episode useful in some way. Please like and subscribe if you enjoyed the content and post any questions or comments. I look forward to seeing you guys next time. Be safe and be profitable.